The second biggest bank failure in US history just happened, and it's sending shockwaves through the markets. Here is what the heck happened and what is happening next. First, let's talk about the Silicon Valley Bank. Although a second bank collapse did just happen, it was announced a few hours ago. More on that in a moment though. So SVB, Silicon Valley Bank for short, was a major bank for tech startups and even provided services to major cryptocurrency companies like Circle, who is the issuer of USDC. But what happened? Where did SVB go wrong? Well, they started getting more cash coming in than they'd actually find loans for. So they had to find some other way to make money with all that money. So they started taking the money from their customers and putting it into long-term mortgage-backed securities. These are supposed to be safe plays, right? But it was a serious mistake because when the Federal Reserve started raising rates, things started to break because as rates went up, the portfolio of SVB's mortgage-backed securities went down. And people, they started taking their money out of SVB due to the low yields the bank was offering, because you could go and get much better rates of return just by buying and holding short-term government bonds. Right now, the US 3-month is paying like 4.6% or something like that. Now, it was deeply irresponsible on the part of SVB to make such a massive bet. In fact, they purchased $80 billion worth of mortgage-backed securities, which is about half of their customers' money locked up in those products. Now, they were forced recently to sell $21 billion worth of these bonds for a $1.8 billion loss. Ouch. That caused a liquidity crunch at the bank, as a good old-fashioned bank run started with depositors all rushing for the exits at the same time, thus bringing down a $180 billion asset under management bank. Crazy stuff, man. But that's not the only bank collapse we've had. Signature Bank also went down today. It had $110 billion in assets under management, and it's actually the third largest ever bank failure in the USA. We got the number 2 and we got the number 3 within 2 days of each other. Now, a few hours ago, US regulators announced that they are actually going to be shutting the bank down in order to avoid the possibility of a wider systemic crisis starting to kick off from all these bank collapses happening. Now, Signature is one of the last standing major crypto banks, so this really hits us in the cryptocurrency industry hard, especially after the fall of Silvergate just last week. The impact of losing the 2 biggest crypto banks is a big deal because these are the major fiat on and off ramps, right? How this is going to affect crypto is still to be determined, but likely not a great thing. The banking landscape right now, it's changing forever right in front of our eyes, and money is moving a lot faster than it has in the past few decades, right? Now, as soon as people, they start to see the smoke like they did at SVB, then they get their money out before the fire destroys their savings, right? Everybody rushes for the exits. The demand for instant liquidity due to the digitization of money is going to change the way banks operate in a big way. This crisis, by the way, is not quite like 2008, although it's tempting to say, look, the banks are collapsing. This is just like 2008 all over again. It's not really what's happening exactly. The banks technically, they do have the money. They just don't have it right now. It's the difference, since it's largely locked up in these longer term fixed income products. Now, before I break down exactly what all of this means and what the reaction from the Fed was, and of course how that's going to affect the wider markets, I just want to let you know that every single week my team and I write a crypto investor newsletter. It's called Wealth Mastery. Look, I know how it goes, right? I'm a crypto investor. I got a family. Busy stuff going on. I know you want to find that altcoin alpha. I know you want to find those airdrops. I know you want to know how to take advantage of some of these really hot opportunities we see in DeFi, getting some great yields. You want to get in on the latest NFT mints. But where do you find the time to do all that stuff? Where do you find the time to find the opportunities? Well, that is where we come in with the Wealth Mastery Investor Report. We're doing all the hard work for you. All you need to do is click open on the gosh darn email, man. That's it. Join our over 55,000 weekly readers and sign up for free by using that link down below in the description. Okay, now, what are the results from all of this banking madness, all these banks collapsing? Well, perhaps the most shocking announcement to come out of all of this collapse crazy of SVB and Signature is that the Federal Reserve has just announced that all depositors will be made whole in a new facility to provide liquidity to banks under stress is being set up from, well, today. So they're bailing out the depositors of these banks. Now, whether we're talking about a company like Roku, which had close to $500 million sitting in SVB, or Circle, the USDC issuer, which had $3.3 billion of USDC's reserves sitting in cash at SVB, these guys can withdraw their funds on March 13th, so today. That's a pretty damn big deal. They got the money, they're getting the money, boom. The crisis went from OMG, the sky is falling, to basically everyone's gonna be totally fine within about 48 hours. feels good. That means that all the startups that were using SVB and Signature can now pay their employees this week, basically continue business as normal. Now, the Fed's new liquidity facility, this is going to allow banks to be able to get liquidity without being forced to sell their mortgage-backed securities or their US Treasury bonds, right? That's going to help prevent another SVB-like collapse. So they're not bailing out the banks or giving the executives big fat golden parachutes like we saw in 2008. They are, however, saying to depositors, we got your backs. And that's a big damn deal because they're saying you can withdraw your cash from these collapsed banks. Basically, they're providing a system-wide backstop for the banking system for depositors, to protect depositors. Now, more banks could fail, right? And if more banks do fail, then depositors are going to be covered under this new scheme. And to be clear, equity holders, bank bond holders, you're done. It's gone to zero. I'm sorry. But such is the risk of being an investor. But why might more banks fail? The reason's really simple. Right now, US government treasuries are offering about 4.5, 4.6% APY. The banks just can't compete, man. They can't compete. And many banks have made the same dumb bet that SVB made. In fact, the FDIC chairman, he came out and said that most banks right now are suffering from unrealized losses at the moment. In fact, $620 billion is what the FDIC is estimating. That's a lot of losses, man. That's just like SVB, but a much bigger number spread across many more banks. Now, if a bank run starts across the board, and we see many other banks having the same situation, then we could see many more banks go under, essentially. People are getting their money out of banks, moving it to bigger, safer banks, and what is culminating to essentially be a series of bank runs, if it continues, right? In order, of course, to take that money and put it somewhere it's actually going to make money, like in US government bonds or in safer banks. Now, smaller banks in particular are at risk here because, quite simply, they don't have the money, they don't have enough diversification to be able to handle all those potential withdrawals. You can, of course, thank the fractional reserve banking practices that let banks lend out like 90% of your money for that BS situation that we're in right now. Also, all of this backstopping of banks is a huge admission from the Federal Reserve because it basically means that they could be firing up the money printers a lot sooner than many people expect. In fact, their bank term funding program, the liquidity program that they're launching right now to protect depositors, it's basically what it is, a money printing program. This is basically a backdoor route to quantitative easing, aka money printing. And what happens when they print up more money? Well, it creates a risk-on environment for risk assets like crypto, like stocks. Japan's already printing money, China's printing money, now it looks like the US might be joining the party. Just remember, the solution to the vast majority of problems that central banks see is more money printing. That is because the Fed and all central banks are hammers, and all they see are nails. And the only way to hit those nails is to print more money. We just went from a major banking crisis and systemic risk to the financial system to the Fed bailing out depositors in a matter of hours. At least they moved quickly on this situation. I'm going to be very curious how all of this factors into the Fed's rate hikes conversation next week. It's going to be a very interesting week in markets, so stay frosty, guys. Okay, that's it. Subscribe now. See you next time.